Kelly, talk to me about these meme stocks because I feel like this segment of the market has gotten out of control, quite frankly. You've got GameStop to start off the year. We're just looking at AMC up, what, it was up 100% yesterday. Why are these specific companies increasing so much in value when at the end of the day, it seems to just be one giant joke?
A Ponzi scheme, more or less, right? So, what is a meme stock? It's a company who perhaps had fallen out of favor for the traditional investing community. And now there are sort of platforms like Reddit where the smaller retail investor are sort of rallying around some of these companies that they feel have been unfairly wronged by big institutional investors, primarily hedge funds, that are basically shorting or betting against these companies. And essentially, what happens is they are out there borrowing the stock that's floating, and they are then selling it to push that share price down and down and down. And one of the sort of rallying calls in this meme stock phenomenon has been looking for companies that have a very significant short interest, meaning a very large percentage of their outstanding shares that have been borrowed and sold short.
So, in other words, these big institutions, what they're doing is they're saying, I don't own the stock. I'm going to borrow the stock, sell it now, try to force the stock price down so that I can buy the stock at a much cheaper price to pay off the loan, effectively, is what they're doing.
Exactly. And now you have David coming to fight Goliath, basically.
Well, but hold on. I was looking at Reddit, and Wall Street Bets in particular is a community on Reddit where that's where a lot of these conversations are happening. Wall Street Bets, the beginning of the year, had 1 million subscribers or members. Right now, there's 10.3 million members in Wall Street Bets. So you've got not just one David, but there's an army of Davids basically going out and buying up these companies where there's significant buying power now because they focus on one specific company, and there's this YOLO mentality. I don't know if you've heard of that. We're young enough where we could say YOLO, which is you only live once is basically the idea there. And in this particular subreddit, they're making big bets with basically all the money that they have and either posting these big wins or these big losses. And at the end of the day, the mentality is, well, look, if I've only got an extra $2,500 to my name, I'm either going to try to turn that 2,500 into 500,000, or I'm going to lose it all. I mean, at the end of the day, it's not going to move the needle for me that much. And that's kind of the mentality that you have coming into these specific stocks, which is a very dangerous mentality to have if you're a retiree, right? So if you're somebody who's thinking about investing in meme stocks at 65 years old as a way to try to make up for
just don't.
Yeah.
Just don't, I think, is the takeaway. So again, how did all of this stuff start? It started because there's an organic growth of people that have access to more information than they've ever had. And the smaller investor is taking issue with the fact that these hedge funds, private equity, are betting against companies. And essentially, when your share price declines, it makes operating your business that much more challenging. I mean, when you think about the balance sheet of a business, you have the equity, which is essentially the collective value of the different classes of stock that you have, and you have all of your debt. So if you are a $30 stock, but you are being bet against and your share price is being arbitrarily depressed down to $15, well, you've just changed the dynamics of your balance sheet considerably.
You've got a lot more debt, right?
And so exactly. So really where the sort of fight against the man came from was this idea that companies like GameStop should not have over 100% of their shares being shorted, and that was making it more challenging for that company to operate their business profitably. I mean, you certainly can't go out and borrow if you have an $8 valuation versus a $40 valuation.
Yeah. I think for me, the biggest issue that I have with these particular companies and kind of the movement that's taking place is not that people are making money from it, right? If you invested in AMC at $2 and it's trading at 100 now, good for you. Should probably take some of those chips off the table. You're not the one that's going to end up getting hurt. To me, this is almost a classic pump and dump strategy, right? You get a group of people, not to pick on the Wall Street Bets guys, but a group of people that start talking about a stock. It's all over the internet. It's all over social media. AMC is the next one we're going to pick. Everybody buy AMC. Hold it till it goes to the moon. So you've got all of these people pouring in. You've got platforms like Robinhood that allow people to buy fractional shares, can make much smaller investments because there's no transaction costs, right? So got a lot more people coming into the fray. You've got these stimulus checks that were in the mail that people are now using to go out and try to double, triple, quadruple because they've heard of a friend of a friend of a friend who was able to do that. And what ends up happening is you have all of this money push in. So it starts to push those stocks up. Well, somebody buying AMC today at 100, I would say the odds of it going back down to $3 or $4 is higher than it going up to $1,000, right? So you're going to have these folks that are like, "Wow, have you heard about AMC? I gotta jump in on this before I miss the boat." We talked about this in another podcast. It's this FOMO phenomenon, this fear of missing out. Well, I got to get in on the next one. When there's no intrinsic value for buying these companies at those prices, it's really just a Ponzi scheme where, hey, I'm going to buy it at 10 and just hope that somebody else buys it at 11. And that's my only reason for going into it. You've got a lot of people who are going to end up getting burned at the end of the day. And I think that's it's a sad story that we haven't heard quite yet, but we're going to hear it.
Well, you talked about Robinhood. It's a trading app that was designed to allow much smaller investors to have an opportunity to invest. And I don't have an account over there, but I understand that when you place a trade, there's basically a celebration, of balloons and whatever else going on. But in addition, within 24 hours of setting up an account on Robinhood, you're being asked if you want to use leverage, that you want to use margin, and you can use substantial amounts of margin inside of these accounts. So when you look at how rapidly these meme stocks can rise, you got to think about it's not a whole bunch of traders that are putting their money in. They're putting in money that's been borrowed to drive these things higher. And really the goal is to force what's called a short squeeze. And that's where you are trying to force the price higher, because every dollar that share price rises is a loss for the hedge fund or private equity, the man that's bet against this. And so by forcing it higher and higher and higher, eventually there's going to be margin calls on the institution side. And they're going to have to buy because they've borrowed, right? They borrowed shares, they sold them. They're going to have to go ahead and start buying also. So a short squeeze is something that then forces the share price even higher. It's interesting because you talked about intrinsic value, and there's not likely a lot of intrinsic value in AMC or GameStop at the prices they're trading for, but there is some value in these companies. I just this morning saw that AMC CEO is actually going to be the first one to take advantage of this opportunity. They are filing with the SEC to sell a new 11.5 million shares,
which is a really smart move by the company. If your stock's trading, quintuple what it was, sell more shares.
I mean, they can raise over $690 million if they actually sell them at the current share price. Whereas if they had done it at $10 a share, we're talking about $100 million. So it's way more accretive to do that right now. It's just interesting to see a CEO that finally stepped up and said, "Look, we're going to take advantage of this." But in the same filing with the SEC, and I'm gonna read this because this came directly from their filing. This is what the CEO of AMC had to say. "We believe that recent volatility in our current market prices reflect market and trading dynamics unrelated to our underlying business or macro or industry fundamentals. And we do not know how long these dynamics are going to last." He continued, and this is in bold in the filing. "Under the circumstances, we caution you against investing in our Class A common stock unless you are prepared to incur the risk of losing all or a substantial portion of your investment." So I think in a nutshell, there is the takeaway. In our crypto podcast that we recently recorded, we talked about how there's so much speculation, so many unknowns that you can't quantify what an appropriate return is. And so when you are buying crypto at this stage, you are speculating, you're not investing. And I think the same argument can be made for these meme stocks. You are 100% speculating. And by all means, if you have the capital to do so, feel free, but understand that that money could go down to nothing.
Well, last time I checked, the pump and dump scheme is illegal, right? And I think it's just a matter of time before we start to see some regulation on how these meme stocks are becoming popular, trading up, and then ultimately trading down. So, thanks, Kelly.
Thanks, Chris.
We'll certainly got a lot more to talk about as far as the meme stocks go in the future. But I'll look forward to revisiting this one with you in a few months.
Absolutely.
Awesome.